Hello everyone, hi, welcome to the channel of Wall Street Mojo.
Watch the video till the end, and also if you are new to this channel, then you can subscribe us by clicking the bell icon.
Friends, today we're going to learn a topic that is called accounts payable and days payable outstanding. What exactly this formula is all about. Let's look at a chart or a graph over here. We can get some insight about what's going on here. Well, we have some data regarding Walmart's store accounts payable and days payable outstanding data over here. So we'll come back. It's fine. For the timing, we need to understand accounts payable is basically, or the days payable outstanding is money that needs to be paid to the suppliers, which needs to be paid to the suppliers, okay, and of the raw material service to the company. So this is one of the most simple and easily understood term under the current liability section. Now what we note over here, we note that the Walmart's account payable has increased over the last 10 years, as you can see, right from the data 2010, 12, 14, 16. See, it has taken a complete rise over here, 41.3, 41.43 billion. I mean, they were resulting into the days of accounts payable increase from approximately to 36 days, right, to 40 days in 2016. You can see it was close enough to in the neighborhood of that, and it started moving up to 40. Okay, so what does this exactly mean? Is this good or is this bad for the company? So in this tutorial, we'll try and look at different aspects of the accounts payable so that we can understand how accounts payable work in the organization settings and why exactly it's important. That's what we are going to learn. So first and the foremost thing we are going to learn is what exactly is accounts payable. What is AP? As the name suggests, accounts payable is the money that needs to be paid to the suppliers. Usually it's shown as the liability in the balance sheet, as it is the liability of the business. Let's take a basic example and understand how this thing works. Let's say there's this company A that produces shoes for men's and women's. So I'll just write shoes. And there's this company B that supplies leather, okay, that supplies leather to company A. Now company A took, let's say company A took 40,000 worth of supplies from company B, right, on credit, which needs to be paid within a month. So in this case, company A has the accounts payable, okay. I mean, company A and company B is company A will be having accounts payable of 40,000, and company B is the creditor, and for company, and the amount of the accounts payable is going to be 40,000, and for B is going to be the account receivable, right, of 40,000. So for him, it's going to be account receivable. So if we look at the situation from the different angle, we'll see that to company B, company A is the debtor, right? For company B, company A is the debtor. So for him, it's account receivable, right? And company A, for company A, company B is the creditor. So for him, it's accounts payable, right? So from the Walmart 2016 filing, we have noted something, that the accounts payable were close enough to in the neighborhood of 38487 million. I'm talking about this was the case in 2016, and in 2015 it was 38410. You can see there is a significant, I mean, let's see the rise actually. So it's just 77, right? So as business are run on a large scale, not every purchase or sale can be in cash. So business can purchase, sale, or sell on credit, or to create more convenience for their partners in the business. So as a result, the concept of accounts payable and account receivable needs to be understood. Under the accrual method of accounting, the receiver of the goods or the service, or a credit must report the liability immediately. So immediately means on the date when the goods or service have been received. On the other hand, having the accounting connotation, accounts payable is also considered as a process which reviews all the payables, right, entries, and whether they are rightly entered into the system or not. So under the accounts payable process, usually following information are reviewed. First is the invoice of the company, I mean invoice from the company supplier. Second, the purchase orders sent by the company. The third is the receiving reports sent by the company, and the fourth is the contracts and the agreements. Let's understand the days payables outstanding. our understanding of the accounts payable wouldn't be complete until we know how the entire thing takes place. Let's have a look. I mean, the most important ratio in regard to the accounts payable is the days payable ratio, or the days payable outstanding, which means that how much time a company takes to pay off the due to the vendors. As simple as that. This is the simple explanation for DPO. The entire process takes place something like this. The first, the company sources its raw material and its finished goods from the vendors, but in the order to keep the cash and manage the cash flow properly, the company goes into what agreement with the vendors, and the vendors usually let the company pay between 15, 30, or 45 days. That means if the company purchases the raw material, semi-finished goods, or products from the vendor, the company is allowed the duration of the time to pay off the due. It helps the company to manage their cash flow better, and also they don't need to pay for the purchases in the cash immediately. And that's the reason the accounts payable is also called as the short term loan. Remember this thing. So the days payable outstanding, or the DPO, is equal to your accounts payable divided by your purchases, if any, into number of days in a year. Let's say it's 365, so you will multiply with 365. Now let's take a very simple accounts payable turnover calculation example from the balance sheet. Let's say the ending inventory, okay, inventory is $500. The beginning inventory, let's say, is $200, and the COGS is, let's say, $500. So your accounts payable is going to be close enough to 200. Now in this example, we need to first find out the purchase during the year. So if you remember the base equation in accounting, we can easily find the purchase, beginning inventory plus the additional purchase during the year is equal to, so I'll just write beginning inventory plus any addition or purchase during the year is equal to your COGS plus you need to add your ending inventory, right? So from this above, what we can see that A over here is equal to your data of 500 plus 500 less AP as 200, right? So with this we can find out the days payable outstanding as the DPO is equal to 200, that is your accounts payable, divided by 800. Okay, and this whole into 365, this whole into 365 will get 91.25 days, right? So some analysts take the number of days in a year as 360. So here we have taken the notation of 365 days. So after analyzing all this, we can make a final analysis or a conclusion saying that accounts payable is a very important concept in any organization. So if the organization follows an accrual, you can say accrual method of accounting, in cash accounting, there is only cash inflow and cash outflow. So thus there is no existence of any accounts payable or accounts receivable, right? So as an investor, while understanding the accounts payable, you also need to make sure that you cross check all the amounts with the vendor statement. If you can get your hands on them, in addition to accounts payable, you need to perform a comprehensive financial statement analysis, FSA, of the company to get the full picture.
So that's it for this particular topic. If you have learned and enjoyed watching this video, please like and comment on this video and subscribe to our channel for the latest updates. Thank you, everyone. Cheers.